The payments industry moves fast. The economics behind it move even faster. Welcome to On the Wire, a show about the economics of payments, the institutions moving money, and the infrastructure underneath it all. This episode is produced by payware using AI voice synthesis, built from primary research, technical documentation, and real market data. No studio, no hosts, just the content, clearly presented. Let's get into it.
You know, it's funny, when you buy something online at home, it's basically magic, right? Like one click, maybe a quick glance at your phone for Face ID, and you're done. But then you step into the office to pay a vendor and
suddenly you're right back in, 2004.
Right, exactly. You're dealing with these emailed PDF invoices, manually typing out routing numbers, waiting 45 days for a wire to clear. We just sort of accept that B2B payments have to be painful. But looking at the research today for this deep dive, clinging to those old habits isn't just annoying, it's actually actively costing companies millions.
Yeah, it really is. The data we're looking at highlights this massive shift toward account-to-account, or A2A, payments. And this isn't just an IT upgrade. It's a fundamental financial strategy that completely changes the health of a business.
So let's jump into the mission for today, which is uncovering the top 3 financial drivers justifying this for enterprise leaders. And let's start with what feels like the most painful way to lose money, losing customers who actually want to pay you.
Right. Involuntary churn. It's huge. In the B2B SaaS world, companies are losing roughly 4 to 6% of their customers every single year simply because, a corporate credit card expired.
Yeah.
Or maybe a monthly limit was hit.
Oh, man.
Or a procurement team issued a new card and they completely forgot to tell the vendor.
It's so frustrating. It's like a magazine losing loyal subscribers just because their mailman changed routes. The desire to buy is still there, but the clunky process blocks it.
Exactly. And that's where A2A completely changes the dynamic. When a vendor shifts to automated A2A renewals, they're setting up a direct, secure pipeline between bank accounts. So it completely bypasses the traditional credit card networks.
Right.
And bank accounts, well, they don't have expiration dates. And they don't have those restrictive corporate card limits either.
Okay, but let me push back here for a second. Will a B2B buyer actually switch from using their corporate card? I mean, companies love holding on to their points or, their existing workflows.
Yeah, it's a valid skepticism. But the behavioral data shows that once buyers experience it, they really don't go back. 82% of B2B buyers say it's more convenient after just one single use.
Wow, 82%.
Yeah, it comes down to human nature. Clicking a secure link and authorizing a payment in 2 seconds from your phone it's infinitely better than logging into a clunky procurement portal to update plastic card details. In one case study of a 25 million euro vendor, just making A2A the primary option saved 66 customers from churning. That retained nearly 400,000 euros in revenue.
Okay, so A2A stops you from losing the customers who actually want to pay. But what about the ones who do stay but just take forever to send the money?
The classic cash flow trap. So traditional invoice flow takes an average of 38 days to finally result in payment. Yeah, that is a lot of capital just sitting in limbo. But with A2A, vendors are embedding secure one-click payment links directly into the digital invoice email. So the accounts payable person gets the email, taps the link, and approves it instantly on their phone.
Wait, this brings up a really interesting psychological point. If a contract has net 30 terms, meaning they legally have 30 days to pay, why would an AP team pay on day 3? I mean, usually they hold on to that cash as long as legally possible, right?
Yeah.
To protect their own working capital.
That's how it used to work, yeah. But what we're seeing is that the pure convenience of a one-click approval often just overrides that old instinct to delay.
Yeah.
You aren't forcing them to pay early. You're just making the task so effortless to cross off their to-do list that they do it immediately.
That's fascinating.
Yeah, and for that same 25 million euro vendor, this dropped their day sales outstanding their DSO, from 38 days down to 22.
Wow. By just making the Pay Now button actually work, that freed up over €1 million in working capital that was previously just trapped in transit.
Exactly. So we've stopped the leaky churn, and we pulled cash into the business weeks faster. But then there's the big question, how does a company justify the setup costs?
Right, because implementing an entirely new payment system sounds incredibly expensive.
Well, this is where the math gets really compelling. You just have to look at the formula. Working capital savings, plus processing savings, plus churn prevention, plus reconciliation savings versus the implementation cost.
Okay, break that down for me.
Sure. Traditional B2B credit card fees are often uncapped, sitting anywhere between 1.2 and 2.5% per transaction, but A2A processing fees hover around just 0.5%.
So you're slashing the transaction tax right off the top.
Right, and then add in the fact that the system automatically reconciles payments with invoices. That saves accounting teams hundreds of hours of manual cross-referencing.
The aha insight from the data here is just wild to me. That same vendor we've been talking about, they spent around 92,500 euros to implement the system, but they saw 562,000 euros in annual benefits. If you're a leader at a company with over 5 million in revenue, that math means this system pays for itself in about 2 months.
Yeah, exactly. When you step back and look at the whole picture, you're plugging the leaks in involuntary churn, you're pulling cash into the business faster with lower DSO, and you're drastically cutting the cost of moving money.
It's a no-brainer. So I want to leave you with a final thought to chew on today. As B2C style, one-click convenience inevitably takes over the B2B world. At what point does sticking with those old PDF invoices and manual bank transfers stop being just a minor annoyance and actually start being a competitive liability?
That's On the Wire, produced by payware, the transaction resolution network for instant A2A payments. This episode was AI generated from payware's published research and documentation. If something sparked a question, the full source material is available at payware.eu. If you work in payments at a bank, an ISV, or a merchant organization, and what you heard is relevant to what you're building, reach out. The conversation doesn't have to stop here. Subscribe to On the Wire wherever you listen to podcasts. The next episode is already waiting.